So this is a preview for the Jackson Hole Symposium that begins late this week, goes on over the weekend. So Jackson Hole is a beautiful place in Wyoming, the United States, surrounded by snow-capped mountains, green fields. Really, all the pictures I've seen from there, I've never been there. Looks like a beautiful, calm place. Every year at the end of August, the Kansas City Fed, holds a long weekend of discussions with senior central bankers. This includes usually the chair of the Federal Reserve, although Janet Yellen skipped this event in the past. But this time she'll be there and she'll provide a speech, and other senior central bankers from the United States and from abroad will be there. Okay, some of them will give speeches, and it's an opportunity for them to talk and to also send some messages. Okay, but some of the speeches are more academic. Some of the data is unfortunately not leaked to the press, and we don't know everything that's going on. So this also leads to some conspiracy theories about what did they actually agree on. If we're seeing some kind of move in markets, maybe it's actually what they plan to do. I would discount these rumors. But anyway, this is a chance for central bankers to provide some messages. The biggest examples were from Bernanke, the former chair of the Fed. In 2012 was, I think, the biggest opportunity. He laid out the prospects, what he's going to do in the next meeting in September and at the end of the year in December. So these were huge events, and markets are watching. Yellen in the past either didn't say anything important or didn't even show up. But this time, there are expectations that things will be different for several reasons. First of all, markets are a bit confused with data. So the good data from the United States, if to put it in a simplistic way, is the good non-farm payrolls. Remember, 2 good months, 292 in June, 255,000 jobs gained in July. Wages are rising, the unemployment rate is low, everything looks good. Housing also, building permits, housing starts released last week were good. New home sales released today, yesterday were even great. That's all positive. On the negative side, we had yet another disappointing retail sales report, and consumption is a very big part, about 70% of the US economy. And GDP data looks bad. We had 3 consecutive quarters of annualized growth of just around 1%. Very poor. Remember, in quarterly terms, that means around 0.2, 0.3. 0.4 if I want to be really generous. And for the United States, this is not good growth. Okay? And in the middle, we have inflation just not going anywhere fast, healthier than here in Europe, but 1.6% on the Fed's favorite figure, the core PCE price index. It's not going anywhere fast. The US economy, if we look at inflation, is not really heating up. Now, I think that regarding September, we should lower our expectations. And there could be even just one reason, okay? US elections. It's heating up. We had the Olympic Games, we had the conventions, then we had some quiet. We had the Olympic Games. But now, especially after Labor Day passes and we get closer to the debates between Donald Trump and Hillary Clinton, the race is heating up. The Fed, regardless of the candidates, actually, does not want to be part of the debate, okay? So Clinton is the incumbent, and Trump is all in for low rates. So if the Fed raises rates in September, it'll be bad for Clinton. They'll get angry. Okay, the Clinton campaign can get angry with the Fed. And if they raise rates, which is not what Trump advocates for, they'll get angry as well. The Fed does not want that kind of stuff. That's one reason not to raise rates. The bigger reason, perhaps, is also that the Fed is dovish, okay? Janet Yellen always errs to the side of the dovishness of the Fed. Also knows, I mentioned a lot of debate about the Fed. They miss their growth forecasts time after time again. Expectations are always set high and reality is lower. So why take a chance in raising rates, okay? So my expectations are high. What we don't know, and what I've shown you before, is the 50-50 chance, according to bond markets, for rate hike in September. I believe that if the data continues to be as it is, basically okay, mostly okay, good enough. The Fed and Clinton is elected, more continuation, and of course Republican control of the House. I mean, more of the same, no changes. The known knowns, if you wish. The Fed can raise rates in December. It's a good time to raise rates, close to Christmas. People are getting on vacation once again, and it's the lame duck session. It's the 2 months between the elections and until the new president is sworn in. So that's a good chance for rate hike. They also have fresh forecasts in December, like now in September. So, but if things go wrong, if Trump is elected and we don't know what's going to be the future, and if the US economy deteriorates, I think things can get worse, and then they will not raise rates. Anyway, in September, I think the chances are low. But even though the expectations, at least on my side, are low, and I'm not the only one, some think she will hint about rate hike in September because some of her colleagues want a rate hike. This creates a bit higher expectations, but I think in general markets don't expect anything in September. Now, apart from rate hike in September, maybe the Fed will change its policy in the future. Maybe she'll throw in things like nominal GDP, inflation targeting of a higher level, or things like that. And even though expectations are low, there is still lots of hype in markets. If you watch financial television like Bloomberg or CNBC, there's lots of talk about it. And there's low volume. We're at the end of August. Many people are on vacation. That means that any headline that comes out from Yellen, either correctly interpreted or wrongly interpreted, can make big splashes. Okay, so it's a small stone can make a big splash because volume is low, and it's also Friday, and traders are trying to square some positions towards the end of the week. So all in all, I think the event itself, were it held on a weekday in July, it would be just another speech from Yellen. But this time, with all this timing, late August, Friday, close to the end of trade, and with all the noise about this, and with not much to talk about, I think it could be quite momentful for markets. Remember, even if the Fed remains dovish, which it is, it doesn't mean that the dollar is going down. Okay, because the Fed or the US dollar remains the cleanest shirt in the dirty pile. The ECB is considering more moves. The Bank of Japan is considering more. The Bank of England faces Brexit and is set to cut rates once again in November. So the US dollar is still on the path, on the very slow. They go as slow as possible, as gradual as possible, but they are still heading towards a rate hike. Even if it's not December, it can be early 2017. So even if we get perhaps a short-term dollar squeeze on very dovish speech from Yellen, it might not last very long, okay? All right, so what else do we have for you?